Hello and welcome back to another edition of Lipper's Fund Flows Insight. My name is Matthew Lemieux. We're going to be going over weekly flows for the week ended January 16th. So here we are a week after one of the previous weeks, which a lot of people were lauding as one of the largest that we've seen on recent records when it came to equity funds in general, ETFs and mutual funds. Even more on the mutual funds, $7.5 billion. A lot of people talking about great rotation, things like that. Maybe investors feeling that they're more comfortable coming back towards risk, especially in domestic equity as well as international equity. Really, investors took it in stride. I mean, we look at the performance of the markets through the end of the week, Wednesday, and there was kind of a steady uptick. We saw some good news out of China on their export numbers, as well as I think the Japanese stock market was doing quite well because we saw some actual depreciation in the yen that was planned by the bank there. So overall, it was good news, but let's really take a look and see kind of how that translated into the flows. Would investors continue the large inflows that we saw last week? So if we look at the macro groups, actually overall we saw $300 million in outflows, and as you can see, it came on the shoulders of outflows for money market funds, negative $9.6 billion out. But again, equity mutual funds, $3.8 billion in second consecutive week of really good inflows. About half as much as we saw last week, but still really good in the grand scheme of things. We'll talk about that a little bit more. Taxable bond funds continued to draw assets at $4.2 billion, and municipals had their second week of plus $1 billion inflows at $1.3 this week. So let's get to the big story, equity funds. You know, a long time, if anyone's been following us, been following kind of the news and looking at how the conventional mutual fund business is done, they've really known ever since really the end of 2008, with a couple spots here and there, the equity mutual funds have really taken it on the chin when it comes to asset flows. We've continued to see this group, specifically domestic, really do very poorly as investors have always kind of slowly shifted some of their allocations over to bond funds. Investors are really looking at the fixed income space, also reaching out to alternatives. So here we are last week. We see $18+ billion going into equity ETFs and mutual funds, 7.5 which are mutual funds. And again this week, $3.8 billion. If you actually look at that volume in a 2-week period, we haven't seen something like this since April 2000. So it is kind of an impressive number. Whether that means that this is the great rotation and whether we're going to kind of see this going forward, we're really going to have to take a look, because if you look back to 2011 and even 2010, really, we've seen these kind of runs happen before, maybe not in this kind of volume of the 2-week period, but again, towards the end of the year or toward the middle of the year, we saw reversals due to whatever news in the markets. So we'll have to see how that goes forward. This week, domestic equity funds brought in about $1.4 billion, and non-domestic brought in about $2.3 billion. Again, really on the shoulders of emerging markets, they've continued to do quite well. So let's look at the ETFs this week. You know, we saw another $7.5 billion, or actually more than that, about $11 billion going into that group last week. This week, we actually see opposite movement, which is some of a surprise for some people. $3.5 billion out for equity ETFs. Again, the big player was SPY, Spider S&P 500, $4.2 billion out. So why did we see, you know, such a big shift in the ETF space? Well, a lot of people, we have to understand that there's some big institutions that take place in this type of market. They're using ETFs within their portfolios. Part of it, I think, as we've seen, now we're at the top of the S&P 500, a 5-year high around that area. Some of it's probably due to profit taking. I think a lot of people are looking at the action in the market. They're seeing a lot of flows coming into equities. They're seeing the levels that the indices are at. They may say maybe this is a top. We'll take some profit, take a little profits off the table, see how that goes forward. Or, you know, we saw such large inflows into ETFs, specific equity ETFs, towards the end of last year. I think some of this could be institutional money where they're just taking a little bit of passive money out of their accounts, and they're going to put that to work somewhere else in the market. There was a bright spot again. EEM, iShares, MSCI Emerging Markets brought in $420 million. So we did see continual interest in the emerging markets, both mutual funds and on ETF equity. So let's go to the next group, which is going to be our taxable bond. Taxable bonds did quite well again this week, $4.2 billion. Again, it was somewhat split over different groups, but investment grade was really where investors went. And corporate investment grades brought in $2 billion. So even those investors that are continuing to be steady investors into taxable bonds, they're going towards the higher quality part of the pie. We did see good flows into international and global bond funds as well, $486 million. Very similar to what we saw in equity. Emerging market debt really taking a good portion of that. High yield, $398 million. I think part of that too, we didn't see a big shift to high yield, but I think some of the good feelings out there on the market, and especially in the stock market, kind of seep through to the high yield space traditionally. So now on to the taxable bond funds and their ETF brethren. Overall, we saw $418 million into that group, which is steady. I mean, you got to realize that this is not as big of a powerhouse when it comes to ETFs as compared to equity. We saw money going into, again, corporate investment grade type products, kind of across the board, evenly out. We did see some outflows, though, continuing from the Treasury products. We actually saw around $181 million going out of Treasury-based ETFs. So a little bit mixed there, not a big signal. Again, a lot of the action for the taxable bond side is really coming from the mutual fund part of the business. All right, so the next group we're going to talk about is municipal debt. If you've been following us, we saw towards the end of the year there was some real weakness in flows from municipal debt bond funds. Again, a lot of that was on the heels of the fiscal cliff issue, people trying to gauge what type of deal we would get and whether that would impact not just the income, not just the tax rates on income dividends, but also whether they were going to pare back some of the tax advantage on municipal debt. That didn't happen. We've seen money come back in. This is the second consecutive month we've seen plus $1 billion flows. The vast majority of it going to our national muni group at $1.1 billion. But again, high yield muni, some investors really reaching for yield in that group, still continue to draw in assets, $422 million for the week. So that leaves us to the last group. As we had said before, this was really the big drag on the overall conventional fund business, $9.6 billion out for the week. The interesting thing is if you look at the split here between institutional and retail, we saw institutional had about 3.1 coming out of their accounts, retail 6.5. This may be associated again with the story that we saw last week. Maybe this is part of the shift where retail investors are feeling more comfortable, not just about the stock market, but maybe about the economy as a whole. You know, we talk about performance numbers, how equity did so well last year. We're only about 3 weeks into the new year and we're above 3% returns in equities across the board for the U.S. So they may just be feeling good, taking money that they've really kind of had on the sideline that's been just sitting there waiting to be put to work, and they brought it back out. So we'll have to continue just again to see how this works, because if this is in fact a rotation back toward equity, we're really going to have to see a run with it. Like I said before, 2011, 2010, for the first 4 months, we saw positive inflows on a month-by-month basis. 2010 about 40 billion, 2011 about 56 billion. Again, towards the end of the year in 2011, we ended the year flat. Money started coming back out. In 2011, we were down almost $100 billion by the end of the year. So it could shift quick, and we've seen it happen, so we're really going to have to keep our eye on that. And one of the things I think we're going to have to continue looking for is as we kind of get into the meat of earnings seasons. You know, at this point, we've only had, I think, somewhere in the 35 companies that have come out with earnings. 65% of those, I believe, have beat expectations. But again, people are seeing that revenues and projections are not as good as people would like. So we're going to have to see how that earnings season comes out to really see if this equity run, and especially in the mutual fund side, is going to continue to go. If you'd like to keep up with this, you can go to our website and take a little bit deeper dive. It's www.lipper.us-fundflows, or come back with us next week and we'll see if this shift continues. Once again, my name is Matthew Lemieux, and thank you for joining us at Lipper's Fund Flows Insight.